Going. Good morning. Today we're going to be talking about what it means to trade with probabilities. I'm Arthur Hur, and you're watching live futures trading with Hur Fund and Hur Fund. Yes, this is the reality of working at home with a small child that has not started daycare or preschool yet. Mommy is not available, but we got permission to record everyone. So we're gonna do this. Bear with me if anything happens and I need to just focus my attention on this one, then I will have to cut it short and we'll pick it up again tomorrow. But let's get going. So what did we do on Friday? Oh, let's just recap. So what we did on Friday is well, I debuted everything very, very awkwardly, and hopefully I'm going to try to be a little less awkward today, but inevitably I will be, which is happening right now as we speak. But what we did was we sold what's called a short straddle, and I'm not going to go into any of the hardcore definitions of anything. The point of this whole live stream and show is not to educate you in a very textbook way. There are plenty of other resources. It's for me to just show what I'm doing, what my process is, and also to just share my own opinions, because the reason why the reason why I started this channel is because there's plenty of information out there, but I have my own opinions and I haven't really seen them expressed anywhere else. So we're going to start this and put something out into the world, into the universe. I'm trading with my own money, right? So if I lose money, hopefully it'll be mildly entertaining for you. But if we do well and if we're successful, then I'll have a record for you to be able to backtrack and see exactly what I'm doing step by step. And I'm going to try to be as transparent and open as possible along the way as I do it. So what did we do on Friday? We started trading crude oil futures particularly. Now, what are futures? They're just it's a leveraged instrument, right? So instead of trading something like what's the oil ETF? Man, it's been such a long time. In any case, we're trading the futures, and so they're leveraged, and the options on them leverage on top of leverage. Kind of serious stuff, okay? So I want to show you how to do this responsibly and safely, which is going to maximize that ratio between what we're risking and what we stand to benefit from, right? Because if we take zero risk, you don't receive any rewards. I'm thinking about your at bat, right? Like if you don't swing the bat, you'll never hit the ball. But you'll never strike out as well. So you have to take a certain amount of risk. Now, what's the right amount of risk to take on? That's what I want to hopefully get into today. So we sold the 7250 straddle for crude oil, and yeah. Do you remember it? I don't know. You weren't here for it actually. But we sold the 7250 straddle, and what we're trying to assume, right, is we're not going to take any directional bet because we don't know what's going to happen in the future. In the past, it always looks obvious. Oh yeah, mortgage-backed security crisis. Yeah, of course things were going to sell off. We're going to have a bear market. Yeah, of course the Fed was going to come in and pump a lot of money into the market, and it was going to go sky high. Of course there was a global pandemic and things sold off. Of course the Fed was going to step in and do all this stuff. It always looks so obvious in hindsight, but no one knows what's going to happen in the future, and that's why the markets are so interesting, because they're smarter than you and me, and they have this amazing predictive power and ability to absorb information at such high speed that they will do things and we won't understand why, and it's only in hindsight, right? So that's why people look at things like technical analysis, draw some lines on the screen. It's like, oh yeah, it's obviously here on support, and there's a ceiling over here, it's going to sell off here. Let me just say one thing about people that might claim that they know what the market is going to do, and them selling a service or a subscription or something. No offense to anyone, and no offense to you if you think that you know what the markets are going to do. I don't, there was a time in my life where I thought I might have an edge, but I think over time it's really, really hard, and it's probably impossible just over a long period of time to be right all the time. And so what I want to do in this channel is hopefully share what it means to trade where you don't know what's going to happen, and you can benefit from the uncertainty that's going to happen over time, and with like the certain levels of uncertainty or fear or volatility. Okay, so let me share my screen. And you, little lady, are probably going to fall asleep soon. So, all right, so let's go to tastytrade. And it's interesting. We are $5. We're literally even. Okay, so we sold this straddle 72.50, the put and the call for 643. Now, what that is like we're kind of collecting. It's called premium, the same way that like an insurance collector will collect a monthly premium for you, and if something happens, they'll pay you up big. But over time, they will always make more money, and it works the same way. You can kind of play that role in this situation. So let me just show you. I'm gonna keep a record, and it's 9:30. Markets just opened. I'm just gonna keep a running record of how we're doing P&L wise, as far as the dates. So what I'm gonna do is I'm just gonna put in. So what, we're at 30, 083.07, and I'm just gonna keep a record of 30.083.07. Okay, let's just make sure that this is all dollars and cents, and then we don't need those things over there. Do the same thing over here. Dollars, and then get rid of just decimal places. So why does it say that we're up $125 when we're completely flat? So what happened was, after we put the trade on, I just watched throughout the day as my P&L just went down and down and down. It wasn't bad. I mean, it went down to 118, but that's what happened on Friday. And the reason why, right, is because we put on a trade. This is what happened on, maybe I'll make this bigger. Okay, so you can kind of tell just from the volume. This is like the 5-minute chart. You can just tell from the volume where the actual trading days were. So this is Friday, Thursday. It's Monday, by the way, July 10th. So the markets, I think oil opens earlier than the normal regular trading hours. So it might have opened at 8:30. I'm not exactly sure. But this is Monday. This is what happened on Friday. We sold that 72.50 straddle probably somewhere around here. And also, we sold not this cycle. Maybe it rolled August 23rd. Either way, this might be trading a little bit higher than what we sold it at, or the current front month future, whatever the price was. So we sold it somewhere. I think it was probably around this range. 10 o'clock, 10:30, 11. I forget when the show was, but it was around 10:30. So I remember that we sold somewhere around a little bit north of 72.50, and because we were looking at the futures curve, July, August, September, October, November, the contracts for those future dates were trading slightly lower. So we were saying that the curve was in backwardation. So it was kind of assuming that the market expected prices to ease up a little bit, go slightly lower. So we just rounded down. It was trading like 72.60 something or other, 68. So we just traded down, or we just rounded down to 72.50. That's how I came up with that number. I like round numbers because, no one can really predict what happens as far as future prices are concerned, but there is significance to these round numbers, and we'll get into it later, but there's significant like gamma hedging that a lot of market makers are doing in order to neutralize their deltas, and it usually happens kind of round numbers. I'm pretty sure that that's how it works. But if you just watch the markets every day, you'll notice like there's very strange phenomena that happens. You know, like there's just a lot of deal flow and a lot of like open not positions but open like trades, open orders that are just resting, and so you'll just see like very strange and interesting and odd behavior around those round numbers. So I don't know, 7250 is not really a round number, but I don't know, 70, 75, 7250. I don't know, round enough for me. I mean, these are big moves anyway. So okay, so we sold it around there, and what happened? The market just went straight up. At least oil did. Right, so you can see it a little more dramatically here, right? Like the market just went straight up, and then that's the end of the day. Now, what happened on Sunday? Well, it sold off a little bit. It's kind of equalizing, and now that the markets are open, so now bid-ask spreads probably tightened up a little bit. We have a little more efficiency. Oh, you are sleeping good. So we're back to even. And that's why it looks like we made all this money, but we're really just making back the money that we lost then. So right now, hey, $10 up. I mean, doesn't really mean anything. If we wanted to get out, we'd probably get out just about where we traded for. Let's take a look at. So we talked about. We mentioned that we were going to talk about like what does it really mean to trade probabilistically, and for me, what it means is trading where you don't know what's going to happen, but you don't know what's going to happen as far as like a direction. Whatever's going to happen in Russia with OPEC. I mean, in terms of in relation to crude oil, what's going to happen with Ukraine? What's going to happen with Saudi Arabia? All of this stuff, we don't have control over it, and so if you base all your trades off of like trying to predict what's going to happen in the future, like there's just no sustainability to be consistent and profitable over time, and it's too stressful. So the only thing you really have control over is not the direction that the market goes in, but what you do have control over is how you react to external events. So the strategy for Hur Fund is to just say, I don't know, and let's take advantage of the fact that no one else knows either. And if they think they know, then they might benefit greatly, or they might get hurt. So there is a way, I know, to look at the curves. How do I do this? Let's see. Let's put these two guys. And I think if I do analysis, we can see. Oops. We can see what happens, or kind of the zones of profitability, right? So we collected $6.43, and so $6.43 away north of 72.50 is going to be somewhere around here, right? Around like the 78, 79 range, and then here around like 66, 66.50. That's when we're going to start feeling some pain. Now, where it's green is where we make money. Where it's red is where we lose money. You'll notice here that, hey, does this thing, we have capped how much money we can make, but if this thing goes lower than 66.50 and keeps going lower, we are looking at literally infinite losses. I mean, look at this. Minus 23,000, you know? Same thing if it goes to 100. Now, what we're doing is we're saying, hey, probabilities probably not going to go there. But if it does go there, we'll have a strategy. And I'll try to get into it. I might not be able to get into it fully today, but this is the whole game, right? Prices will normally cluster where they normally are, right? Because markets try to digest all the information, reduce bid-ask spreads, and become efficient. A perfectly efficient market. This is this whole like push-pull tension between like market efficiency, efficient market theorists and people that are like really strong, that feel very strongly about it, and people that feel like kind of lukewarm about it, and people that are like, no, of course it's not, because then if markets were perfectly efficient, then you wouldn't be able to make any money. And I mean, every argument is valid. I think about efficiency in terms of, I think it's true. If something is perfectly efficient, you would have zero volatility. And I think about efficiency in relation to volatility. Because when you have high volatility, you have high bid-ask spreads, you have price going up and down in wild swings, because what's it trying to do? It's trying to digest all the information that's happening. And when there's a lot of information and a lot of news, the market is trying to digest it all, and so there will be a lot of buyers and sellers, and a lot of and the market makers have no edge, right? Or what they try to do is they try to protect their bottom line, and so they get their edge back by just making markets really wide, which means that, hey, if let's say a stock is supposed to be trading at $100, they'll say, okay, well, you want to buy this, you have to buy it at 105. All right, you want to sell it, you have to sell it at 95. And so they have enough positions on that'll allow them to kind of make up that difference between what the theoretical price is and what they're setting the sale prices, buying and selling price. Okay, so let's look at this right now. This whole, first of all, I don't know what this line is. It's kind of annoying, but I guess it's just telling you that you're 38 days out from expiration. So let's take this guy, and then let's take, let's bring it in here. I was doing some other stuff in preparation for another video, but let's close that guy. Oh, little sneak peek as far as something that I'm working on. This is just kind of like brownie in motion. I plotted out like 500 random walks, and just to kind of show like how the central limit theorem looks like visually, you know, as far as like, you don't really know what's going to happen over here, you don't know what's going to happen anywhere, but like probabilistically, you know, in a perfectly random situation, you'll see some clustering, you know, and so the best bet as far as picking direction is to just say, you know what, it's most likely going to stay around where it is right now, and that's obviously going to change at any point, right? So if you go from here, right, okay, well, obviously it didn't go in what we expected, but like everything resets, right? So everything would kind of like stay around there, and that's the way that we're going to trade. We're going to trade completely neutrally. Enough about that. In any case, let's bring Photoshop over to. That I quit on. Let's see. Let's bring Photoshop. Oh, I see. Okay. Let's bring Photoshop. We have to have a window open. Over to this guy. I've got just a lot of things going on, so apologies for kind of going all over the place. In any case, here is our graph. So this is what it looks like at expiration, right? We are going to be, our max profit would be 6,000 or so, and as long as we're in between 66.50 and 78, 79, we'll be profitable. Now we're going to take our trade off. It's not going to get anywhere near 6,000, and but if we get somewhere like around 2,000, yeah, we can take our trade off, move on to the next one. And the thing is, this is also only at expiration, right? So we sold the August straddle. So that would be the third week in August is when, on Friday, is when expiration happens. So what we're doing is we're trading what's going to happen in price, and we're trading the uncertainty around what's going to happen to price between now and the third week in August. So let's bring that guy in, and then let's bring in let's go a little bit wider, so like maybe the 1 hour chart, and let's bring this in. Okay, so we'll bring that in, and what we're going to do is we're going to try to look at these two things in relation to each other. So, before I do that, we talked about the fact that this is what's going to happen at expiration, but right now what's happening is, let's go back to our like kind of bright blue. It's a very sharp linear line, and that's because that's how it would work if you were to like just buy the future or sell the future. You just, whatever it is, if the stock is trading over here, right, then it would just be like a straight line, right? We can do this. Didn't really work. I mean, I can really make it. See, this is what happens. This is the problem when you're like an actual designer, animator. You get like really OCD about like stuff like this. But it would be a straight line, right? Like, so if the price went up, then we'd be green, right? I think here would be green, and then if we lost money, then everything would be red over here. What we're doing is one of these positions, right? One of these positions says things are going to go higher, which is selling the put, and the other one is saying that it's going to go lower, which is selling the call. And when you put them together, that's how you get that little cone. But that cone is really only at expiration. So what's happening now? That curve, and it's kind of not really necessary to really know what these curves look like, but I would assume that because of the benefit of time and all this data, you'll probably have something that's closer to that, right? Where we're just kind of hovering around flat, right? And on Friday let's go a little bit closer, right? So we're kind of doing something like that, as opposed to a straight line. And on Friday we're probably doing something like this, right? So we're actually in the red. Today we're probably a little bit higher, but the idea is that over time, this is what's going to happen. It's going to start to become more like this, right? And I mean, not exactly, because it'll probably just do something like this, and then eventually get to their at expiration. So let's look at this. I don't know if it's helpful or not, but I think it is. But just to look at these two things in relation to each other, right? So I'm just going to take this sucker, bring it to the top, and I'm not going to do all the fancy stuff like turn it into a smart object and everything, because we're not really doing that right now. But let's see. So 7850. Let's just put. So let's see. 78 is around there. Oh, now I really should have put in a smart object. I'm scaling up again now. Nope. Go ahead. Make it a smart object. What we're going to do is we're going to mask this out, actually. Yeah. And then we'll kind of try to save a thing of it. Oh, I have to rasterize this sucker before I, alright, let's apply it so that we can just, and then now we can make it into a smart object. That's all we'll do. Alright. The whole option shift and shift, they keep changing whether when you scale things up. So now I guess you scale up proportionally when you hold down option as opposed to just holding down shift also. Life of being a designer, living in the world of Adobe. Let's just kind of rough this out. We're 7250 is around there, so if we kind of go, okay, we have to go significantly bigger. 50, somewhere around there. Let's get an anchor point. Where's our anchor point? I can't find it. Is it because we have a smart object? 6280. I don't know. Doesn't make sense for me to spend too much time, but this is the idea, right? This around here is where we start to lose money. Around here, anything north of there, we lose money. Anything south of here, we lose money. And we are just betting on that, what the price is going to be by here, right? So time is going to go by, maybe it goes up, maybe it goes down, right? Maybe it goes up, then down. We're betting on the fact that it's going to stay in this range. This is the zone of profitability. When it goes higher than here, we lose money. It goes lower than here, we lose money. Now, how do you protect that move? The whole point of like trading quantitatively is like, what do you do when your expectations or what your trade, when the underlying moves against your strategy? The whole reason why I built Trade Hur, and you can see if you haven't seen the video, it's like a trading bot that I programmed up last year. The whole reason why I built it was to do what's called reverse gamma scalping. So when it gets to this point, right, what we're going to do is we're just going to automatically say, what I'm going to buy some actual like static delta. That's what it's called. I'm going to buy the future itself, and my deltas are not going to actually be one, right? So maybe I'll trade the minis. I'll trade mini crude oil, and I'll trade like just enough so that if the move keeps going up and we're losing infinite money, what we gain from buying the actual future will offset those losses. And it's this weird kind of like art, because how much do you hedge, right? Like, what if you buy a bunch of futures and then the price reverts again and you're back in the green? Now you've lost money on the futures that you bought, right? So it's this very subjective like practice, and it's an art form. And so the Trade Hur strategy, what it did was it bought and sold from, so let's say the price was here. It was kind of like, first of all, it tightened everything up because it was trading in a much shorter time frame. What we're doing right now is we're trading over the course of weeks. That was trading over the course of just a single day. And what it did was it would say, okay, well, based on whatever the price is doing, right? Like, based on whatever the price is doing, if it gets over here, buy it. If it gets over here, sell it, right? Like if it's trading over here, then just sell it. And then if you buy it here, then set a stop over here. And if it goes higher, trail the stop. If you get to a certain level of profitability, then this stop jumps up to that level so that we can at least protect and have a little bit of a cushion. And if it keeps going higher, then if it keeps going higher, wait. But if the level of profitability between where your stop is, which is automatically going to be profitable or neutral, if it goes beyond a certain point, then jump up and then track it from whatever it is. So put another trailing stop. So the whole thing was using trailing stops and manually, or not manually, but like algorithmically adjusted stops in order to lock in profits and let things run as far as possible. And so what you ended up having was, like, if you look at, so maybe it would do 200 trades or 50 trades or thousands of trades. What would happen is you would end up with a bunch of losses that were about the same, right? Because if you put a trade on and it gets triggered, so you're long, and then it goes straight down, then that's just a straight loss. But like you've capped it, right? So it would lock in over here. So let's say these were all of your losing trades, right? And then you'd have a couple that were, less, and then you would have a bunch of small kind of winning trades, right? Like just to account for commissions and fees and everything else. It's like, okay, well, if it's 4 ticks, 5 ticks above the trade price, then put it there, and where these numbers were set were what I was tweaking along with a bunch of other things, and we'll eventually get into it later. But like, so you have like a whole bunch of these things, right, where the price was profitable, and so we jumped from being putting a stop that would have been a loss to just a stop that's kind of neutral or just locks in some profit, right? And so that's what most of these things would be. And then you'd have like a couple winning trades, and then you'd have like just these huge mammoth wins, and those are the ones where it just kept going up and you just keep trailing it. And what would happen is, since there were two stops, one above and one below, one was locking in the profit, and then the other one was still getting you into the trade, getting you into a new trade. And so you would have two stops, right, that were still going up, and based on how much your P&L was, they would look like this, and then they would look like then they would look like this, and then if the underlying reversed, right, if it went in the opposite direction, right, then all of a sudden you would be short, and you would be short from here, and it would just kind of like rinse and repeat in this like kind of recursive manner, so that you would always have two positions on, one to either minimize losses or lock in profits, and then the other one to get you into the new trade going in the opposite direction. That's how it worked. I don't know how much I talked about like what the actual probabilities were, but the idea behind this, I added these probabilities of profit, and if you look at, let's go back to that curve. So this puts on both positions, right? Like if I were to just sell the just the put, right? The assumption is that this is just going to go higher, right? If I were to sell just the call, this is the assumption that it's going to get lower. Now, why is this profit? Like, what does this have to do with probabilities? Well, when you're selling options, because you're collecting a premium. Oh, good. We're back to being lower again. It looks like everything is ticking up. So. Also, we're not going to touch this position unless it goes higher than whatever it is, 78.50, or lower than 66.50, or if we're profitable. That's the other thing. Because we're collecting a premium up front, that is going to provide a little bit of a cushion. And so when you look at the options chain, right, our position is here. Our deltas talk about like price movement, right? So because we're assuming a neutral position of what the future's of what's gonna happen in the future, if the underlying trade's above our strike price, then we'll be short. If it trades below our stock price or our strike price, then we'll be long. And each of these levels, right, each of these price points has a certain, where's the delta strikes? Well, I guess you can use this like percent in the money or out of the money. It's the same thing. It's more or less the same thing as delta. How do I configure this? I don't like this. I don't like all this stuff. Extrinsic and delta are all we really need. I don't know what this stuff is. Extrinsic. Oh wait, that's beta weighted delta. I want the regular delta. Not that guy. I think that should work. Okay. How come it's not showing up? All right. Well, either way, what your deltas are gonna tell you is how likely based on how much time you have left and how much volatility is currently trading in the markets, how likely by that expiration it's going to reach this level. How likely is it going to, this is the other thing about like options chains, is that like when you look at a graph, just to go on a tiny rant, right? When you look on a graph, the numbers go up, and when, you know, so when a stock goes up, you see the thing go up, and when it goes down, you see it go down. But in an options chain, like when you go up, the price goes down, and when you go down, the price goes up. I don't know, weird paradox, but it is what it is. It doesn't really matter so much as far as just the tools, as long as you know what your positions are and you can get in and out, like that's all that really matters. But the deltas are going to be an indication of how likely the stock is going to get, or the future or the underlying is going to get to that price by that date. So it's going to narrow over time because there's less time, and so that cone of probability is going to get smaller. Your deltas, wherever it's trading, is going to be 50-50, right? Because you don't know if it's going to go up or down. So your deltas at the money are going to be 50-50, and further away, they're going to be smaller. Anyway, I've taken up enough of your time. It's been over 30 minutes, so thank you for bearing with me. Let's pick it up again tomorrow, and I need to turn the air conditioner back on because she's so hot. Okay, take care. I will see you tomorrow. Oh, if you have any questions, just email me, arthur@arthurhur.com. And also, if you haven't already, go ahead and subscribe below so that we can stay in touch, and you can get any updates as far as when I do live streams and also when I post edited videos. I'm going to take some of the ideas that I'm laying out here, and I'm going to hopefully consolidate them down into like more like manageable conceptual videos. So thanks for bearing with me. Take care.